All right. They were trying to bring in a new board letter sheet. Let me just write like that. All right. So whatever we are doing today, because I'm mixing up so many students, yeah, there is a very important group here that I missed out on something. I don't know how we missed it out, which I would want us to write at the back of the books, what we call flexible budgeting. Because now the other group haijaanza process costing, nikianza tena hiyo itatusumbua. So flexible budgeting will be something that we can all of us understand pretty fast. And this student who has drawn here kindly, if you can be very nice, if you know how to do it, are you able to delete that blue thing? That is if God touches you. Flexible budgeting. Flexible budgeting. So from your understanding this word flexible, when we mention the word flexible, what comes to your mind, my good students? Something which changes, right? Something that changes. So basically this will be a budget which you shall be doing what here, somebody? Why they are not talking to me? They don't know how important this thing is. If they knew, wangekuwa aggressive nayo, wangekuwa aggressive sana nayo. So right there pretty fast, let me get my email here. Tell us there that a flexible budget is a budget that is adjusted. Is a budget that is adjusted. Is a budget that is adjusted to the actual level of activity. I repeat, a flexible budget is a budget that is adjusted to the actual level of activity. To the actual level of activity, rather than being fixed at one level. Rather than being fixed at one level. Soda yangu iko wapi? Unajipenda peke yako tu. A flexible budget is a budget that is adjusted to the actual level of activity rather than being fixed at one level. It provides a more realistic comparison. It provides a more realistic comparison. It provides a more realistic comparison between. It provides a more realistic comparison between budgeted and actual performance. It provides a more realistic comparison between budgeted and actual performance. Full stop there. Give me a small title there. Purpose of flexible budgets. Purpose of flexible budgets. Purpose of flexible budgets. Or even objectives. Sometimes they ask us to give them objectives of a flexible budget. Number one, to compare like with like. To compare like with like. Compare like with like. Like this, to compare like with what here? With like. Into brackets, actual versus adjusted budget. Into brackets, actual versus adjusted budget. The second purpose, to provide meaningful variances. To provide meaningful variances. To provide meaningful variances. Number three, to improve performance evaluation. To improve performance evaluation. To improve performance evaluation. To improve performance evaluation. Now, ladies and gentlemen, the most important thing will be for us to appreciate how we normally get flexing ratio. Here you must always compute what we call the flexing ratio. How do we get this flexing ratio? I repeat something. I can repeat, I don't have a problem. Are we okay? So flexing ratio, we normally take the actual budget, actual output, sorry. Actual output divided by budgeted output. Anytime they want us to do a flexible budget, we must always take the actual output divided by budgeted what here, somebody? Output. Yes. So mention there illustration. Illustration. For us to be able to appreciate, ladies and gentlemen, this one, we must do some small little example here, really. Little example, really here. So we have here budget, and then we have here actual. So we start with the output. The output here is 1,000. The actual is 800. 800 units. You can double underline that. That is output. So the budgeted output is 1,000 units. Actual is 800 what here? 800 units. And then, ladies and gentlemen, now we happen to be having our cost card. So our cost card, we start with what we call direct material. Direct material cost. So direct material cost, ladies and gentlemen, here we have, in this case here, direct material cost, we have 500,000. This is, in this case here, 550,000. Then we have direct labor cost. Direct labor cost. Here we have 600,000 budgeted. Here we have, in this case here, 520,000. 520,000. Then we have variable overheads. We have variable overhead. Variable overhead cost, where this is 300,000 and this is 280,000. 280,000. And then we have fixed overhead cost. Fixed overhead cost. Fixed overhead cost, ladies and gentlemen, the budget one is 1 million. The budget one is 1 million, while the actual one is 950,000. 950,000. So we are required here to do something very simple. We are required here to do something pretty simple. Number one, we are required here to develop a flexible budget. Develop a flexible budget. Develop a flexible budget. And then number two, compare flexible budget and the actual information and the actual info and the actual information to determine variances. To determine variances like that. To determine variances. So wanafunzi wa online, I would want to get confirmations from you whether we are together up to here. Have you been able to write this question, the online students? And I'm so happy today. I can see we are 50 something. We must be smelling the coffee of exams. Exams must be just around the corner, right? Two possibilities: either the exam is very near, or the higher you go, the cooler it becomes. So anytime you hear about this examiner talking about what here, somebody, flexible budget, you must start by giving us a flexing ratio. Yeah, flexing ratio, or at times they call it the flexing index. Flexing index. So is there somebody who can give me the flexing index here from the formula that I've just given you up there? From the formula that I've just given you up there, ladies and gentlemen, are you able to give me this flexing index? Purity Kananu, great. 0.8, eh? Terry must be a very good student. OM must be a very good student. Thank you very much. Because what they have known, these great ninjas, they have already known this. They have already known this, that we have what we call the flexing. We have what we call the flexing ratio. We have what we call the flexing ratio. And to get this flexing ratio, we normally take actual output. We normally take actual output, yeah? And then we divide this by what, yeah, somebody? Budgeted output. Budgeted output. At times they use the word production, eh? It will be actual production all over budgeted production. So if they change the words, they shall never confuse you. Now, ladies and gentlemen, this actual output have given me the figure. The actual output, I'll be able to pull it from this actual 800 divided by what here, somebody? 1,000, which will give us what figure? Somebody here? 0.8, which will give us 0.8, which will give us 0.8. Now, ladies and gentlemen, once you get that, now I want to give you the idea behind this. I want to give you the idea behind this. So the idea behind this, which is really, really important, is that you use this flexing index to change variable costs. Use the flexing index to change what? Variable costs. That is a very, very important thing, because we can only flex variable components. We can never flex fixed costs. Never. So how do we do this, Mwalimu? This note, use flexing index to change variable what? Yes, somebody? To change variable costs. So what do you know about direct expenses? The word direct means what here? Variable. So any variable thing shall be multiplied by point what here, somebody? 0.8. Any variable item shall be flexed. What will happen to the fixed overhead cost? That will remain the same. That never changes. That one never ever changes. So we only flex, we only change those flexible items, and the flexible items are what here, somebody? Those are variable or direct costs. Now, my good students, having understood that, I would want us to come here and write the terminology there, flexible budget. So you write there, flexible. So you write here, flexible budget. So we are writing there, flexible budget. So we are going to copy this the way it is. So we have what here, somebody? Direct mat costs. So the direct mat cost, when you flex, it will be 500,000, this one, times 0.8. The other thing you're supposed to be knowing, my friends, is that you only flex the budget, Don't flex the actual. Never flex the actual. Utapata mwingine amekimbilia hapa, ananiambia, mwalimu sasa, mimi nimeflex actual. And you see me, I'm very friendly. So most of these guys, they even come and tell me after exams, mwalimu, you are a very good man. Come, we take a kanyama here. So when I go there, and then they start telling me that they flexed actual. We only flex what your budgetary item, and not all the budgetary items, but the variable ones. So then what is the figure that we have here, the flexed direct material cost? 500,000 times 0.8. 400,000? 400,000, right? 400,000. I presuppose that the online students are able to see what Mwalimu is doing. The online students, I believe they're able to see what I'm doing. Thank you so much. Then we have here direct labor cost. So the direct labor cost, ladies and gentlemen, I'm taking here 600,000 times 0.8, which then will give me what figure? Thank you so much, Nashetu. Thank you so much, Terry. Terry is giving me 480,000 here. Terry is giving me 480,000 there. After that, ladies and gentlemen, I can see variable overheads. From that, I can now see the variable overheads. Variable overheads, ladies and gentlemen, what do we have here? We have 300,000 times 0.8. These ones here, which gave you guys what figure? 240,000, which gave you guys 240,000. Now, ladies and gentlemen, having gotten that, I would want us straight away to go to the fixed overhead cost. So the fixed overhead cost, don't flex this. Fixed overhead cost, ladies and gentlemen, generally fixed cost, Kikuyu watasema kwamba hizi ni zile cost ambazo ziko na hinya. Unajua hinya ni nini? Hinya. Nguvu. Yeah. That is why we call them what here, somebody? Shut down costs. If you're not able to pay them up, you'll close your business because it's rent, etc. Those ones shall never be flexed. If you get 0 students, if you don't sell anything, you can't go down on your knees and then you start begging your landlord to reduce rent. Those ones will always remain the same. They're always carried at 100% the way they are. Don't flex them. Don't flex them. Don't flex them. Don't flex them like that, which is what here? $1 million. So number 1, we are done with the number 1. Now we go to number what here, somebody? Number 2, where they want us to do side by side. We place the actual stuff here to enable us, give them what here, somebody? Variances. Variances. So what is the actual material cost? What is the actual material cost? I can see the actual is here. The actual, I can see it here. So the actual material cost, mwalimu, hiyo ni 550,000. 550,000. Direct labor cost ni ngapi, somebody? 520,000. Ooh, all right. And then, ladies and gentlemen, the variable overhead costs are what? Yes, these ones you copy them the way they are. You copy them the way they are. So in this case here, the variable overhead, I'm able to see a figure of 280,000, right? And then I can see for fixed overheads, I have a cool 950,000. And then now we shall be able to come here and give them what here, somebody? Variances. Variances. I hope I'm not moving very fast. I just wanted to clear this section. I hope the online ninjas are able to follow. I hope. Thank you so much. I can see OGMO. I can see OGMO. These guys are following. So please go ahead and give me the variances there. Variance means that you're subtracting. Yeah, whenever they want you to get variable, no. Whenever they want you to get variances using flexible budgeting approach, don't start in this case here doing MPV, MUV. No, because you'll see some questions where they tell you get variances using flexible approach. So for flexible approach, you simply give us the flexible budget there. And then in this case here, we have what here, somebody are, and then you start subtracting. So we start with the first one, which is direct material cost, where we take 400,000 minus 550,000. That gives us what here, somebody? 150,000. Positive or negative? No, I don't want you to give me that response. I want you to tell me whether it's adverse or favorable. What makes you think it's adverse? We spent more. We budgeted to spend 400,000, and then we get to go to what we spent 550. We spent more. So this is what here, somebody? Adverse. This is adverse, like that. Ladies and gentlemen, when you are getting variances without thinking much that I spent more than I had budgeted, itakusumbua, confuse. Unafaa ujue vitu fulani hapa. Ikiwa ni expenses and you are getting variances, for those of you who are privileged to be having children, mtoto anapozaliwa namna hii, this is a problem we shall overcome. Mtoto anapozaliwa namna hii, akianza kuongea kabisa, jina ile ya kwanza anaongea kabisa ni gani? Yeah, it is either tata ama ba. Lazima aseme baba, isn't it? Imagine mama umemshughulikia. Unajua pia ni maisha ni unfair. Anapoanza kuongea anaita baba, ushasikia amesema mama hata siku moja? Hakuna. Ni either baba, hata kama ni Muhindi, atasema tata namna hiyo. So wakati ni expenses and you're getting, ladies and gentlemen, variances, you shall always use the concept of BA. For expenses, use BA. That is budget minus what here, somebody? Actual. BA. Budget minus actual. So like now, this is the budget, and this is what here, somebody? Actual. And whenever I get a negative, I know it's adverse. It's adverse. BA. So for 80,000 minus 520, because it's BA, budget first. So for 80,000 minus 520,000 gives me 80. 40,000 negative, which will be what here? Adverse? Adverse, like that. 40,000 minus 280,000. 40,000 now favorable, isn't it? No. 40,000 what here? Adverse. 40,000 adverse. And then lastly, for fixed overheads, ladies and gentlemen, I can see abracadabra here. For fixed overheads, ladies and gentlemen, I can see abracadabra there. Are you able to see that abracadabra? So the abracadabra that we have here is a million minus 950,000, which gives me 50,000 favorable, isn't it? 50,000 favorable. So please do me a favor. Please, come and add all those variances, please. Add all those variances, please, for you to be able to give me total variance. So it will be minus 150,000, minus 40,000, minus 40,000, plus 50,000, which gives us 180,000. 180,000 what here, somebody? Adverse, eh? Let me see what my online students are telling me. Let me see what my online students are telling me. 180,000 what here, somebody? Adverse, thank you so much. Now, could you kindly be of a favor to me? Yeah, please come here and give me the total is here. What is the total cost here? The total budgeted cost. Please give me 400,000 plus 480,000 plus 240,000 plus a million. 2120,000. Thank you so much. How about the total actual? Total actual, please add up. Total actual. This one here will give me what figure? Oh, yeah, they are not even talking to me. Huh? Actual. 2.3 million, isn't it? 2.3 million. So, ladies and gentlemen, could you kindly confirm whether your total variance will be still 180,000 if you took 21 budget minus this total actual? If you took 20,000 minus 2,300,000, is it agreeing? Yeah, it's agreeing. But of course, we are only able to do that kind of a reconciliation here in class. If you go to an exam, will you be trying to see whether the answers are correct? Never try. And if you try, and then you get that they are not agreeing, what is our principle? Just move on. JMO. JMO. It's a very serious, very serious principle, even in my, daily operations. Nikienda mahali nikataliwe, najua ni just what? Najua kukataliwe na mingi. Maybe supply imekataa, namna hiyo. Just do what here, somebody. Move on. It's God who is telling you maneno mzuri kombe. Just move on. Just move on. All right. Now I want to give you some work. So up to here, let me just check what the online guys are saying because I saw some internet disruption. At least you are okay. At least you are okay. I can see they are saying yes. Now, ladies and gentlemen, I want you to do me a favor. Now nataka niwaeke kwa group. Na nataka mudiscuss. Nataka mudiscuss sana. Kuna vitu nataka mudiscuss sana. Nataka mnipatie maswali. Hii maswali 4. Munipatie advantages of budgets. Ukikataa, ukisema just move on pia ni sawa. Unajua unasema mwalimu amesema just move on, kila kitu, Advantages of what here, somebody? Budgets. That's number 1. Number 2, I want you to differentiate between incremental budgeting, incremental budgeting versus zero-based budgeting. Zero-based budgeting. You can go to Google, whichever. Get those answers, write them down, and then we get to discuss. Ladies and gentlemen, the last one, I want you to give me, in this case here, rolling budgets. What are rolling budgets? Last but not least, we have in this case here differentiate between top-down budgeting versus, in this case here, bottom-up budgeting. Kama ile ya Dr. William Ruto. Yeah. So I'll give you exactly 15 minutes. Please, all of us, when I come back, all of us should be having answers for this. These ones here will save most of you. They'll save most of you. You'll get, in this case, at times they even avoid all the budgets questions, but they give you these theories. 20 marks. 20 marks. So kila mtu afanye research yake. But the students who are with me here physically, who are privileged to be with me here physically, you guys can get to discuss. Can get to discuss. Alafu tuone namna gani. So the online ninjas, I would expect you to give me very good answers as well. Would have needed for you to be able to do what here, to pass this paper if they brought this kind of a question. So let's summarize. We summarize everything up. So then what's a rolling budget? A forward-looking budget. Don't tell me like I read some student scripts. Of course, a rolling budget is a budget that keeps on rolling. You're professional. You're professional. A rolling budget, ladies and gentlemen, is a budget that behaves like this. So we have here January, February, March, April, May, June, July, August, September, October, November, December. So assuming we have done a budget for 2021, 2026, and this budget happens to be a rolling budget. No. Let me talk of 2027 because you are ready to be there. You know, budget, we prepared budget quite early in advance. So we've been able to do a budget of 2027. So 2026 is over. We start now, January 2027. So January 2027, we push our actual versus our budget, and then the month is over. The month of January is over. If it's a rolling budget, we will scrap the already, in this case here, exhausted period. Any period that we have already been able to consume, we scrap it out of our budget, and then we replace it with the next year's what year? January, for example. So we'll be able to have here January, another new budget, now which runs 2028, which runs from February 2027 to the end of January 2028, such that we shall always be 12 months ahead, so that the budget will be forward-looking, it will be rolling like that. So tell us, ladies and gentlemen, for this rolling budget, that a rolling budget is a continuous budget. I know you wrote yours, but it's no problem. It's a continuous budget that is updated regularly. A rolling budget is a continuous budget that is updated regularly, e.g. monthly, quarterly, etc., by adding a new period, as the current one ends, by adding a new period as the current one ends. A rolling budget is a continuous budget that is updated regularly, e.g. monthly, quarterly, etc., by adding a new period as the current one ends. This has been asked severally. Advantages of rolling budgets. Advantages of rolling budgets. Advantages of rolling budgets. Advantage of rolling budgets, always up to date. That's dash one. Always up to date. Always up to date. Another dash, improves planning accuracy. Improves planning accuracy. Improves planning accuracy. Another dash there, responds to changes quickly. Responds to changes quickly. Responds to changes quickly. Responds to changes quickly. Disadvantages. Disadvantages. Disadvantages of rolling budgets. Of course, number one, it needs expertise. A rolling budget needs expertise, which is rare. Which is rare. Needs expertise. Number two, time consuming. Ukiulizwa disadvantage, unasema vitu mbili. Expertise, time consuming. Time consuming. The last one requires frequent revisions. Requires frequent revisions. So meaning that it may need intensive labor. You may need a department which purely exists to be making whatever budgets like that. So those are rolling budgets. With your permission, I'll go to an incremental budget. So incremental budgets, of course, are those budgets that are used by lazy companies, lazy countries, like Kenya is a lazy country. For an incremental budget, don't write that. For an incremental budget, ladies and gentlemen, we don't develop a budget from scratch. We look at this year's budget, and then we add like 10% for next year, isn't it? So we have this year's budget being the base. We simply say, take everything of last year, multiply it by 1.1, 1.1. That's an incremental budget. So right there, incremental budget. An incremental budget is prepared. An incremental budget is prepared. And an incremental budget, on break to discuss what's written on the board. Number 1 to 4. So Anne Monene, what haven't you written? Is it disadvantages? Anne Monene, is it disadvantage of the rolling budget? You simply write high level. Now you're writing high level. Like, for example, definition of rolling budget. It is a continuous budget that is updated regularly. Updated regularly, e.g., monthly, quarterly, etc. by adding a new period as the current one ends. A rolling budget is a continuous budget that is updated regularly, e.g., monthly, quarterly, by adding a new period as the current one ends. What you could do to Anne Monena and the rest who have not been able to take up these notes simply because they came in a little bit late, etc. Is there a possibility of somebody taking a screenshot of what you have written and then send it to the group for them to also have advantages and disadvantages? Tonditi, great. Incremental budget. So an incremental budget is prepared by adjusting the previous year's budget, for expected changes. An incremental budget is prepared by adjusting the previous year's budget for expected changes. Does it have any advantage which will make lazy companies and countries to like it? Oh yes, mention the advantages. Number 1, simple. Simple to prepare. That's why lazy people, lazy companies like it. Simple to prepare. Number 2, quick to prepare. Quick. You can prepare this quite quickly. So it's not time consuming. No time consuming at all. Yeah. Disadvantages. Encourages inefficiency. Hata ukiwa lazy manager who did what we call budget padding, yeah, you're not able to consume your budget effectively last year. Come this year, baada kunyang'anya, tunasema hapana, sini incremental, tunakuongeza. Yeah, so it encourages what here, somebody? Inefficiency. It ignores waste. That's number 2. Ignores waste. Another dash there. Assumes that the past is always correct. Assumes that the past is always what here? Correct. Because we are making use of the past to predict our future budgetary estimates. So long as upate juju, tunaenda mbele. So tuende kwa zero-based budget. If you go to American companies and American government, UK, European countries, most of them, they are making use of what we call zero-based what here? Budget. And a zero-based budget, ladies and gentlemen, you must always justify every budgetary item. Justification. So here you don't look at what we had last year. You tell your managers and everyone else, ladies and gentlemen, in this case here, to come up with budget estimates over every activity, and then they justify. They justify. So tell us there that a ZBB, we normally call it ZBB. ZBB for zero-based budgeting. Starts from scratch into brackets 0. Starts from scratch into brackets 0. And every expenditure must be justified. And every expenditure must be justified. So the key thing is that nothing is assumed. No. Everything is justified. If you're not able to justify, we won't be able to give you any budget line. Advantages, dash, eliminates waste. Advantages, dash, eliminates waste. Number 2, improves efficiency. Improves efficiency. Number 3, it is a better resource allocation system. It is a better resource allocation system. So we'll only be able to allocate resources to justifiable activities where we shall be able to get a return on investment. So it's a better resource allocation system or model. Disadvantages? Hebu niambie disadvantage. Time consuming, yes. Always time consuming. Complex to implement. Complex to implement. Requires skilled managers. Requires skilled managers. I like what I'm seeing Bonita telling me. Costly to implement. Savlane wants me to repeat. I don't know what they want me to repeat exactly. Is it advantages, disadvantages? Savlane, remember it's high level. Yeah, it requires more effort. It's expensive. I like that. Is it possible for somebody to screenshot their disadvantages and then send this to Savlane? Disadvantages, remember, this is a very time-consuming exercise. It's very complex to implement, requires skilled managers. You've been told others they are very, very expensive, etc. My friend Savlane, I hope you're together. Yes. Yes. We explain it is expensive. You can imagine in this case here, you know, when it is a zero-based budget, you have to, number 1, ignore all the suppliers that you have currently. And you start collecting information from scratch. Because everything you're assuming, everything is not okay. So you invite fresh bids. You have all your managers. In this case, you're trying. I mean, you will be forced in this case here to have a whole department doing zero-based budget. Yes. Oh, you think it's cheaper? Okay. When you compare department, you see, very good. Actually, you are even in this case here, putting it very nicely here. When you compare incremental versus what you are doing, even that element that everybody is looking for this information, and then you will be able to do what here, take this to the managers. Yeah, you know, it is basically, in this case here, what we call bottom up. You start from down there. It's quite an evolving process. You can't compare it with incremental, where you'll take last year's budget and then multiply by 1.1 everything. You see, for incremental, you're not even involving anybody. You're simply taking it up and you multiply. So this other zero-based is quite expensive because you're involving everybody. You're involving everybody. You're involving everybody. All right. So somebody wants me to repeat there. Yeah, actually somebody has been able to put that definition up there. And again, the very best will be somebody who has this particular notes, who has taken very good notes, to take a screenshot and then they share it with what here, they share it with everybody in the group. course, now I have less than 30 minutes. I have less than 30 minutes and I have a whole past paper question to do. Ladies and gentlemen, whenever we are doing these budgets, we normally establish what we call a budget committee. Ukiangalia kwa past paper yako amekuuliza what is a budget committee and the composition and the functions of a budget committee. Wamekuuliza sana, andika title hapo juu, budget committee. Budget committee. Andika title hapo, budget committee. Alafu niambie hapo, a budget committee is a group. A group of senior managers. A group of senior managers responsible for preparing, coordinating, and monitoring budgets. I repeat, a budget committee is a group of senior managers responsible for preparing, coordinating, and monitoring what ya somebody budgets. And you get a title up, composition of the budget committee. I'm so sure, madam, at your workplace, you must be having a budget committee, inakuwa ya watu kama watatu namna hii. So composition of the budget committee, number one, finance manager. Finance manager. That's number one. We have departmental heads. Departmental heads must sit there. May not be everybody, but at least. Then number three, we have a senior executives. Senior executives. And always, the finance manager is the chair. Finance manager is always the chair of this committee. Functions of the budget committee. Functions of the budget committee. Functions of the budget committee. Number one, they set budget policies. They set budget policies. So they normally develop what we call a policy manual, a budgetary policy manual. Number one. Number two, Number two, coordinate departmental budgets. Coordinate departmental budgets. Number three, resolve budgetary conflicts. Number three, resolve budgetary conflicts. Resolve budgetary conflicts. Number four, monitor performance. They monitor performance. They monitor performance. They monitor performance. Number five, lastly, they approve the final budget. They approve the final budget. So remember, number one, they set budget policies. They set the budget policies. So basically, they come up with the budget policy manual. Budget policy manual. Budget policy manual. So now, ladies and gentlemen, with your permission, I want us to look at one past paper question, and then we shall be able to continue with these theories in the interest of time. Let me bring my book. So we are doing December 2024. December 2024. December 2024. Question number 4. We start with question number 4C. December 2024. Question number 4C. Once you get it, mention there, oh yeah, December 2024. Question number 4C. Albo, albo, albo. Alto, alto, not albo. Alto. Once you get it, ladies and gentlemen, you mentioned right away. Correct. Are we there? Thank you so much. Thank you so much. So you're told Alto Limited manufactures a single product branded PQ. The following data relates to its operations for the month of October 2024. So we have sales, production. We have sales there. You can see everything there. They want us to give them a flexible budget for the month of October 2024 for the actual sales of 29,000 units. So we have budget here. Then we have actual there. Yeah. So they wanted to confuse you. They gave you the sales units. So we have 30,000. And then here we have 29,000. 29,000. Then, ladies and gentlemen, we have production. Production, we have 30,000. And then we have, in this case here, 30,000. So from this information that is given, I want somebody to give me a flexing ratio. Give me a flexing ratio. Give me a flexing ratio, and I would want to be very, very clear here. One. 0 point. Ladies and gentlemen, please listen and listen to me very well. If you want never ever to confuse this, even if, for example, production here was to be 28, even if production was to be 28,000, whenever they give you sales and then they give you what here, somebody, you have to be very careful because they want you to get a 0. This is an examiner who does not wish to success. Whenever they give you sales and production, remember to end up with expenses, tunasema cost of sales. Because in this flexing concept, we don't have space for inventory. Another space for inventory. All right. So then whenever they give us the 2, always remember that the flexing ratio formula changes a little bit. So you talk of actual units sold all over, in this case here, budgeted sales units. So basically you use sales. With your production, you'll be building what we call inventory. So use sales. So then that will be 29,000 over 30,000. So you take the actual is 29,000, and this is what here? 30,000. Don't confuse that. And if the answer you are getting is ugly, the decimals, don't use those decimals. Use 29 over what here, somebody? Use 29 over 30, like that, as a fraction. And then you can go ahead and do your flexible budget. So this one, I will be able to go ahead and do my flexible budget. So I have my flexible. I love management accounting. It is the best subject in CPA, best. So flexible budget. So we start with sales. So we have direct materials. We have direct labor. Fixed overheads. Then we have, in this case here, the net income. I will not flex that. So the first one I can see is for 20,000. Direct materials, ladies and gentlemen, direct materials, I can see 120,000. Then we have direct labor. What am I able to see there? 150. 150,000. 150,000. Then we have fixed overheads of 67,500. So remember, when it's flexed, you must multiply flexible items, variable items, with the flexing ratio. So times 29 over 30. Times 29 over 30. Times 29 over 30. This one will not be flexed whatsoever. This one is fixed. This one will go the way it is. So is there somebody who is able to give me this figure for 20,000 times 29 over 30? What are we able to get? 406? 406,000. Thank you so much. 406,000. How about direct materials? Direct materials, are you able to see that? 116,000. 116,000. Aha. Inakuja 145,000. How about fixed overhead? They remain the same, isn't it? 67,500. And now you are through with your flexible budget. Remember, this examiner never wanted a variance statement, eh? So the because read the question again. The question simply wanted us to do what? Flexible budget. Is that okay? But now, assuming I will be the examiner, I can't leave it there. I'm a rough examiner. What I will do, I will come and ask you for the variance statement. So then if they want me to do the variance statement, I need to come and give them here 41. Are you able to see the column of actual? 41, 411, 800. The next one again is somebody? 123,000. And then we have here 144,000. Don't forget that tomorrow we have a financial management class running from what time? The daytime class. Is it 10 or 9? Yeah. We had said what time? We can change it now. 1 p.m. Apana. 1 p.m. is subject of outing. Tomorrow. FM. Monday to Wednesday. 9, yes. So tomorrow, are there students who are with me here who are doing financial management? So DT not evening. I don't teach evening. I don't teach financial evening. I don't teach evening. So come here and give us variances. So variances, remember if it is expenses is bar. Expenses is bar. Budget minus what here, somebody? Actual. How about sales? Sales, when I want to get my variance, it will be ob. If you want to get it always right. So like the first one is sales, isn't it? So this will be ab. You take actually here, minus what here, somebody bar? Budget. So can somebody give me this variance? 411,800 minus 406,000. What are we getting? 10,000? 10, I'm at 5. 5,800, favorable, right? Because you got to what here, somebody, if you look at this very well. Remember, don't tell me that these are sales variances which are exceptional. No. When you do ab, then the sign now takes care of itself. You can see the sales here, actual sales was higher than the budget. And then now when you go to expenses, like now here we have expenses, material cost, etc. Now this one is bar. It's budget minus what here, somebody? Actual. So is there somebody who is able to give me this bar thing? 7,000 adverse. Negative that is, isn't it? All right. And then we have 145,000 minus 144,000, which gives me 1,000 positive, isn't it? So that is what here, somebody? Favorable, isn't it? And then lastly, ladies and gentlemen, lastly, 67,500 minus 70,000. That gives us what figure? 2,500. Adverse, I'm told. Don't even get the totals, but you can just try this one. Yeah, you can try this one, but why should you do it? Don't even try to get nothing over that. We'll only mark those variances, and that will be it. Ladies and gentlemen, it has been a pleasure hosting you this afternoon. I'm looking forward to meeting you again tomorrow now for financial management. So what I've given you is enough dose. I have another class starting at 4 exactly, not 4. Is it 4 or 5? Ngoja kidogo. MA is 1 p.m. Yes, nothing is changing. MA is 1 p.m. MA is 1 p.m. Yeah, MA is 1 p.m. MA is 1 p.m. Otherwise, that is good enough. It's my next class is supposed to be beginning at 4. Yes, we shall overcome. We shall overcome. So there are times I'm not able to stretch for you. It's because I'm the most busiest CPA lecturer. Yeah, we never discussed top-down admin. Yes, I agree. I agree. That's why I gave them to you as what he has assignment, isn't it? Top-down, this is where you force your employees. The top management, they come up with a budget, and then they expect the juniors to implement. That is top-down. It is dictatorial style of coming up with what here. Style of coming up with what here, somebody. Yeah, style of coming up with a budget. So we have the president and ministers, they develop a budget without participation. Yeah, so this is non-participative. The other employees are not involved at all. When it is, in this case here, bottom up, now we have the other employees involved. They come up with it from down there. They take it up for approvals. The managers will be able to give a few suggested areas to simply correct, and then you continue. The authority, somebody can be able to easily give you what here, those assignments. Yeah, in class, I believe somebody will be able to give you. So somebody is saying, do we have a class at 7 p.m.? I don't know. You know, these classes are really mixed up. Remember, maybe it's the camera. I'm not your normal teacher. Mimi class yangu imeisha. Sikasema mwalimu amesema ati hakuna class. I'm not your normal teacher. Mimi nakuja kuwasaidia hapa na hapa. Kesho class ni saa 3 FM. 9 a.m. You're able to join online from wherever you are. But if you're in Nairobi, then you should be able to do what here to come and join us here physically. FR revision, I will start it as well. Don't worry. What time is best for you for FR? Tomorrow at 3? FR tomorrow at 3? What time is best? I'm here now at your service. What time is best?